We're going to continue with problem 7-1B, and this was the Dune Company that we were working with. And what you need to know about this particular problem is when you are buying and selling units of inventory, if it's the same type of inventory that you're buying over and over again, and you're purchasing the same type of inventory at different dates, then sometimes the cost can rise throughout the accounting period that you are recording. In this particular problem, we're going to be using the perpetual inventory system, which means we're keeping a continuous record of our inventory at all times. And so what we have to use is the inventory cards to record the perpetual inventory method. And because we are buying units that are identical and we're buying them at different times, then the unit cost can be different. And so we're going to want to decide which inventory cost method we want to use, because in this chapter they introduced to us several inventory costing methods that management can choose to use. On this particular problem, what we're going to be working on is the FIFO method. So it's going to take me just a second to bring that up. So hang tight here. So you now should be able to see problem 7-1B. I've brought it back up on the screen for you today, and you'll notice that I filled in the information that we have talked about the last time that we met. And so we're just going to continue on with this problem until we get it finished. In this particular problem, the inventory type of method that we are using is what we call the first in, first out method. And what happens with the first in, first out method is the first units that you buy are going to be the first units that you're going to sell. And so it's in a perpetual inventory system, it's really important to keep a continuous record of the amount of merchandise inventory that you have on hand at all times. So in a perpetual inventory system, every date where we are buying merchandise, we need to update our merchandise inventory account. And every date where we are selling merchandise, we also have to update the merchandise inventory account. In a perpetual inventory system, in a manual system, we keep up with the count of our inventory and the cost of our inventory on what we call a cost card. That cost card is what we had started the last time that we met, and that's what you can see here on your screen. And so today I probably want to start with the May 8th transaction and talk to you about it. I think that's a good starting point because we're starting at the beginning of the month. You'll notice that I've already recorded some information about this transaction, but be sure and read your transactions carefully. We're up here on May the 8th, and we are purchasing 60 units of our merchandise, and it cost us on this May 8th date $1,260. So if you multiplied 60 units that you bought times $1,260, the total amount of your purchase is $75,600. Now, last chapter you learned to record that purchase in a journal. So in this chapter, they're assuming that you already know how to do that. But for review, what we would do is we would debit our merchandise inventory for $75,600, and we would credit our accounts payable for $75,600. This would be the journal entry that we would use to record the purchase. Because we want to keep a continuous record of merchandise inventory, we're going to also, in addition to the journal entry, we're going to have to keep up with that information through the cost card. And in this problem, they're wanting you to complete this cost card. So I'm going to go to my purchases column because on May 8th, it was a purchases transaction. We bought 60 units, as you can see that I've recorded here. They cost us $1,260 a piece. So if you multiplied 60 times 1260, it will give you a total cost of that purchase of $75,600. Now, I want you to notice what happens here. In the middle columns, we don't record anything because this transaction was a purchase. If this had been a sale, we would have recorded the information in these middle columns here. But since it's a purchase, we just recorded in the purchases columns. You'll see that these are broken down into purchases, cost of merchandise sold, and inventory. And so this was a purchase transaction. It had to be recorded in the purchases column. We start with our quantity, the cost of each unit, and then multiply the two, and that will give you the total cost. To finish each transaction, we need to update our ending inventory. What we had left over from last month, which was on April the 30th, we had 30 units in ending inventory that cost us $1,240 a piece. The total cost of that ending inventory on April the 30th is $37,200. So because we made a purchase of inventory, we're just adding to that layer of ending inventory that we already had. So you'll notice on this purchases transaction, they've got two separate blocks here. This first block is to bring the 30 units down of ending inventory that you had left over from April 30th. The cost of that ending inventory at April 30th was $1,240, and then we multiplied, and the total cost of the ending inventory at April the 30th is $37,200. Because we have just made a new purchase at a different cost, see, our costs are different here, we have to create a new layer of inventory. And so our last purchase, which was on May the 8th, we got a new layer in ending inventory of 60 units at $1,260, which is $75,600. If you have a question, just feel free to join right in there, turn your microphone on, and just ask me the question, and I'll do my best to answer that question for you. So I'm hoping that you understand what we've done so far. Do you have a question at this point in time? I don't hear any questions, so I'm going to move on to the May 10th transaction, which is up right here. So look at our information that they give us. This is the only way we can know what to do. And notice on May the 10th, we had a sale. We sold 50 units, and the selling price was $2,000. I want to really emphasize to you there that that $2,000 is the selling price, or the marked up price of the inventory that we sold. We actually sold a total amount of $100,000. We got that by taking 50 units and multiplying it by the selling price of $2,000 each, and that will give you $100,000. This is your total sales. when you are creating a journal entry, like we learned how to do in the last chapter, every time you make a sale, there will be two journal entries. The first journal entry is to record the sale. You might remember that we would have debited, most likely, accounts receivable and credited our sales account for the gross amount of the sales in this case, because we don't know anything about purchases, discounts, and all that other stuff that they taught us in the last chapter. They're just kind of ignoring it now. So our total sales are going to be 100,000. So you would debit in the journal accounts receivable and credit sales for an amount of 100,000. You'll remember that in chapters 1 through 4, we said that we put it in the journal, then we need to post it to the ledger, and then we need to prepare a trial balance. All the steps of the accounting cycle that we learned still apply in this chapter too. The only difference is in this chapter, we're learning about how to record the inventory in the cost card. And this is the selling price on May the 10th. It is not the cost. The only thing that will go in the cost card are only the cost of the inventory. You might remember that the second journal entry that we would have to record for a sale is to show that the cost of merchandise sold is increasing or going to be debited, and the merchandise inventory will be decreasing. Now, in the last chapter, they told you what the cost of goods sold amount is. In this chapter, we have to determine that cost of merchandise sold in the cost card itself. So, because we don't know what the amount of the cost of merchandise sold is, we have to determine that. And what you need to know is that in the May 10th transaction, we sold 50 units. So we're going to have to figure out what the cost of those 50 units are for us from the previous information about our ending inventory that we had looked at. So if we're selling 50 units, all of this units, 30 units at $12.40 will have been sold. The reason for that is we're using the first in, first out method, which means the first units that we have in our ending inventory are going to be the first units that we sell. So all 30 units of those that were in our ending inventory that came from the April 30th transaction are sold now. So we need to put it in the cost of merchandise sold columns for what it cost us. We actually sold 50 units, but 30 of those came from this layer right here, and the layer was from the ending inventory. And the 30 units at $12.40 are the first units that we're going to count for in the sale. The total cost of those units were $37,200. So $37,200 goes here as the first part of this cost of merchandise sold. Now we've accounted for 30 units. We actually sold 50 units according to the May 10th transaction. So we've got to account for the remaining 20 units, and those 20 units are going to come from the 60 units that we have available in ending inventory at a cost of $12.60. And we're going to have to record the total cost of those, so we need to calculate the amount. So I'm going to put in 20 units times $12.60. This is where the information's right here. 20 times $12.60 is 25,200. So if I wanted to know the total cost of merchandise sold that I would have to put in that second journal entry on my journal, I would combine both of these items together. So 37,200 plus 25,200 means that our total cost of merchandise sold for the May 10th transaction is 62,400. That 62,400 would go in the second journal entry for the sale. That's the total of the cost of merchandise sold. So you sold 50 units, 30 of them came from the first layer, and the remaining 20 of the 50 units that we sold came from the second layer, or the May 8th purchase, if you want to call it that. So what we've got left over in our ending inventory now is 40 units at $12.60. And so I would need to multiply 40 units times $12.60, and that will give you 50,400. And so my ending inventory consists of 40 units in ending inventory. The total cost of my ending inventory is 50,400. Again, we're using the first in, first out method. So the first units that were purchased are going to be the first units that are sold. In the next transaction that happened on May the 19th, we had another sale. We sold 20 more units. The selling price was $2,000. So the total amount of the sales is $40,000. In your journal, you would have debited accounts receivable and credited your sales for $40,000. In the journal, we will also need to create a second entry to record the cost of the merchandise sold. We find the cost of merchandise sold on the cost card. We sold 20 units. We sold 20 out of the 40 that we had in ending inventory. The cost of those units was $12.60. That came from May 8th purchase. And then you're going to multiply 20 times $12.60, and that will give you the cost of the merchandise sold for this transaction. So in our journal entry, the second journal entry for this sale, we would debit the cost of merchandise sold and credit our merchandise inventory for the cost, which in this case is 25,200. What we have left over are 20 units, because we sold 20 of the 40 we had left over from before. $12.60 is the cost of each one of these, and then you would multiply the two of these, and it'll give you a total ending inventory amount, 25,200. Do I have any questions so far about anything that I've done? I don't hear any questions, so I will continue on with the May 28th transaction. This time it was a purchase. We bought 80 units. The 80 units cost us $12.60. This is the actual cost price here. If you multiplied 80 times $12.60, it will give you a total purchase of 100,800. In your journal, you would have debited um, merchandise inventory for 100,800 and would have credited accounts payable for 100,800. That's how you would have recorded the journal entry for the purchase on the 28th of May. In your cost card, we have to keep up with the amount of merchandise that we have on hand at all times. So again, on May the 28th, because this was a purchase, we need to record our quantity in the purchases column. The quantity that we bought was 80 units. At an amount of $12.60. Excuse me, I'm looking at the wrong thing here. Let me go back up here. 80 units, it was at $12.60 that we purchased on May the 28th. And if you multiply 80 units times 1260, it'll give you 100,800. Now again, I'm going to bring down the 20 units that I had at 1260. I had this left over from the last transaction, so I want to put in the amount of my ending inventory on May the 19th first, and then I'm going to swing over what I've just purchased. And class, on this one, what you could have done is you really didn't have to have two separate layers because the purchase price was the same as before. You could have just combined these together and said that there were 100 units in ending inventory on May the 28th at $126,000 as the total cost. You could have combined these two together. But I'm glad that they kept them separate because that's what you've been doing before. And I just wanted to mention that since these two had the same cost with them, you could have just combined them together to have one layer of inventory. But I guess they wanted you to realize too that the first ones that you get in are going to be the first ones sold. So that would be a reason why they would have probably kept the separate layers here. But I've taught out of some different textbooks, and sometimes I've seen it presented a little bit different here. I hope I haven't confused you. Are there any questions so far? And I'm going to move on to the June 5th transaction. On June 5th, we had another sale. We sold 40 units. Notice that the selling price went up this time by $22.50. In other words, we've increased the selling price of our units. These are identical units, so we know that there was an increase in our selling price. The increase was from $2,000 up to $2,250. This is our selling price, so 40 times 2,250 gives you 90,000 in total sales. With the sales transactions, there are two journal entries that you would make. So we would debit accounts receivable and credit sales for 90,000 on our first transaction, and then our cost card will tell us the amount of our cost of goods sold in this transaction. Now, we sold 40 units. So on our cost card, those 40 units have to have the costs that were associated with them from the ending inventory. And so we sold all of the first layer at $12.60. So in other words, all of this layer right here is gone. And then we sold, again, I need to look back to see how much we sold. We sold 40 units, so I've accounted for 20 of those, so I have 20 remaining to account for, and that 20 was at $12.60. And so we would multiply 20 times 12.60, and that would give you 25,200. So our total cost of goods sold for that transaction would be the combination of these two items, 25,200 plus 25,200 would give you 50,400. That's the total of your cost of merchandise sold. So in your journal, you would have debited cost of merchandise sold for 50,400 and credited merchandise inventory for 50,400. On the cost card, we have left 40 units. So 40 units, because we sold 40 out of the 80 that we had from previously at $12.60, would give you the amount of the ending inventory. So 40 units times $12.60 is going to give you 50,400. That is my end. Uh-oh, I must have subtracted wrong. Let's see here. I had 80 units and I sold 40 units, so it should leave you with 40 units. Let me go back and see if there's something else in here that is wrong. It says I sold 40 units. Oh, I did something here, class, so I'm glad I did that, so I can show you how we can fix that or remedy that mistake. You sold this entire layer. Right here is where we recorded it, on the first line of the cost of merchandise sold. Then you sold 20 of 80 units. So subtract 20 from 80, and that gives you 60 units. So there was a math error there. So 60 units times 1260 is going to give you 75,600. Now, let's check our work. That looks better. So it was a simple math error. Again, 80 units minus 20 units is 60 units that you have left at 1260, which is 75,600. Moving on to the next transaction in June, we sold an additional 25 units at $22.50 for a total sales amount $56,250. When we are recording sales under a perpetual inventory system, there are two journal entries. The first is to record the sales transaction. So we would debit accounts receivable and credit our sales for $56,250. That's our first transaction that we would record for our sales. The second transaction that would go in the journal would be a debit to cost of merchandise sold and a credit to merchandise inventory. We don't know what the amount is. We have to figure it on our cost card. So we need to look at the total number of units that we sold. We sold 25 units. The only layer we had to draw from had a cost of $12.60. So I'm going to multiply 25 units times 1260, and that will give me 31,500. This is your cost of merchandise sold. So in the second journal entry for the sale, we debit cost of merchandise sold and credit merchandise inventory for 31,500. The amount that we have left in ending inventory on June 16th, you will have to determine by taking the 60 units and subtracting 25 from that. So 60 minus 25 leaves you with 35 units. At 1260, and that'll give you a total ending inventory cost of 44,100. Then we're going to move on to June the 21st. We have a purchase. We bought 35 units at $1,264. Notice the price went up from $1,260 to $1,264. The total purchase price is $44,240. We bought 35 units. So that's got to go in the purchases column. The cost of those units were $1,264. And you would multiply 35 times 1264, which would give you 44,240. So in our journal, we would debit merchandise inventory and credit accounts payable for 44,240. That's the total amount of our purchase. Because these have different costs associated with them, we're going to bring down our ending inventory from the previous transaction, which was 35 at 1260, which is 44,100. And then we're going to swing across what we just purchased, which was an additional 35 units at 1264, which is 44,240. So what this is telling us is that we have in ending inventory a total of 70 units at a total cost of $88,340. So this ending inventory amount is going to end up on our balance sheet in the merchandise inventory account, and the total of that again is going to be 8,340 as of June 21st. Do I have any questions on anything I've done so far? So in my last transaction, I've got another sale. Notice the amount of my sale is $22.50, same amount that we sold for before. 44 times 2250 is 99,000. That's the total amount of our sales. So in our journal, there would be two journal entries in a perpetual inventory system. The first one would be to record the sale. We would debit accounts receivable and credit sales for $99,000. The second journal entry would involve the cost of merchandise sold, which we don't know what that is yet. We're going to need to figure the cost of merchandise sold on June 28th. So we sold 44 units on June the 28th. So we have sold all of the first layer of our inventory, 35 units at $12.60 is 44,100. And because we sold 44 units, we had 44 units that we sold. We accounted for 35 units. What I have left is 9 units that I have to draw from the 1264 cost. And then I'm going to multiply 9 times 1264. And that's going to give me 11,376. All right, I sold 44 units. I sold this entire layer. I sold 9 of 35. 35 minus 9 is going to leave you with 26 units. That cost us $12.64. And 26 times $12.64 equals $32,864. All right, and then the last thing they want you to do is to show the balances. And so what you're going to have to do is determine the total amount of the cost of goods sold. And we do that by adding up each one of these columns here. This last column right here for the total cost of the merchandise sold is going to be added together. So in my calculator, I'm going to put down 30,000 plus 18,600 plus 37,200 plus 37,200 plus 25,200 plus 25,200 plus 25,200 plus 25,200 plus 31,500 plus 44,100 plus 11,376. And if I've calculated that right, it's 310,776. All right. Again, to find the total of the cost of merchandise sold, you have to combine all of the amounts in this column together, and that's how I got 310,776. Now, the thing about the ending inventory, the amount that they want you to show here, is from the very last transaction. The amount of the ending inventory is 32,864. Notice this time I did not add up all of these. I just took the last transaction because what you had left over is what you have in ending inventory for your merchandise inventory. So the total of this cost of merchandise sold would end up on the income statement in the cost of merchandise sold account. The total of this will end up on the balance sheet in the merchandise inventory account. This is the ending balance of the merchandise inventory account. Do I have any questions at all about the cost card? I don't hear any questions, so I'm going to move on to the second part of this problem. And what they want you to do is to determine the total sales and the total cost of merchandise for the period. They want you to journalize the entries in sales and cost of merchandise sold account. Assume that all sales were on account. Well, as we went through these transactions, I told you every time we made a sale, we had to update the accounts receivable, or we would record that in your journal, and we would credit the sales account. What they've done here is they're wanting you to show that transaction. So we'd have a debit to accounts receivable and a credit to sales. Now what you're going to have to do is figure out the amount of the sales. And we didn't keep a record of that, but I'm going to keep a record of it now. So I'm going to clear out my calculator and I'm going to move it down here to where it's out of the way. Look at each one of your sales transactions. Notice they totaled up the amount of sales for you. So we're going to add up all sales that happened this 3-month period of time. So I'm going to start with the April 11th sale, which was $80,000. I'm going to add that to the April 30th sale, which was $60,000. I'm going to add my May 10th sale, which was $100,000. I'm going to add to that my May 19th sale of $40,000. I'm going to add to that the June 5th sale of $90,000. I'm going to add to that the June 16th sale of $56,250. And I'm going to add my last sale, which was $99,000 on June 28th. All of these combined are the total sales. So in your journal entry where we're recording the sale, you're going to be putting the amounts in, and I'm going to check my work just to make sure my math is correct. and it is. I'm going to move my calculator up a little bit so you can see these balances on the next part. The remainder of these journal entries, because every time we make a sale, you have to update the cost of merchandise sold, and you have to credit your merchandise inventory. Remember, in a perpetual inventory system, we want to keep a record of all of the merchandise cost that we have sold, and that cost of merchandise sold we found right here on the cost card at 310,776. 310,776. And I'm going to check my work there. So as you can see in this transaction, every time you make a sale, your accounts receivable went up and your sales went up. This was the total sales for the 3-month period. Our cost of merchandise sold went up because it's an expense account, and the amount of the merchandise sold comes that cost card. The merchandise inventory went down because we sold our merchandise inventory, which is reducing the asset account. That's why it's credited, and it too is for the amount of the cost of merchandise sold. Do I have any questions about what I did there? On the next part of this, they want you to determine the gross profit from the sales for the period. Now, the gross profit is found by subtracting the cost of merchandise sold from the total amount of the sales. Your sales total amount was $525,250. That's what I have in my calculator already. So I'm just going to subtract from it my cost of merchandise sold of 310,776, and the remaining amount is what I'm calling my gross profit. That was your profit before we have deducted any operating expenses for this company. We learned how to calculate gross profit in the last chapter. So again, to get my gross profit, I take my sales amount, total sales, subtract the total cost of merchandise sold for that period of time, and that will leave you with 214,774. Is there a question about this? On the fourth part, they want you to determine the ending inventory cost on June 30th. So on June 30th, our balance in the ending inventory, remember this is the ending inventory column, the last amount that you recorded there, 32,864, is the ending inventory amount. Again, it comes right off your cost card. It's the last amount that you figured. That's your ending inventory, and this will end up on your balance sheet in the merchandise inventory account that goes with your current assets. That's something that we learned last chapter. So we're just adding to basically what you learned in the last chapter. And then on the last question, it says, based on the preceding data, would you expect the inventory using the last in, first out method to be higher or lower? Last in, first out means the last units that you purchase are going to be the first ones that you sell. What we did in this problem is the first in, first out method. In the first in, first out method, the first units in inventory are going to be the first ones that are sold. So what we end up doing is valuing our ending inventory cost at the latest purchase price for that ending inventory. So since you're buying it during periods of rising prices, the FIFO method has the highest amount of ending inventory cost. The LIFO method will give you a lower amount. So the answer here is, if it's the LIFO method, is going to give you a lower amount for the ending inventory. Do I have any questions at all about this problem? If you don't understand question number 5, I think you will when we do a problem concerning the LIFO method, which is what we're going to be doing in problem 0702B the next time that we meet. So this time we only did the FIFO method. If you want to, I would start my homework problem and try to go through problem 7-01A, because it's very similar to what I just did for you today. Are there any questions at all about what's happening today? I guess we need to talk about the next time that we're going to meet. Because we're going to go on break, we won't meet on Friday. This is Wednesday, and this is the last day of classes for this week. We're not going to meet on Monday either, because it's Easter holiday. So the next time we come back will be next Wednesday. We're going on vacation, and so I won't be back in the virtual classroom with you until next week when we come back, which is on Wednesday the 15th. I hope you have a wonderful break, and stay safe and stay inside. Just try to enjoy yourself as much as you can. I'll take questions now. If there are no questions, I will stop sharing this. Go ahead.
Sorry. So this assignment, is it still due on track with this coming weekend?
No, it looks like I'm going to have to extend it. Let's see. Oh, no, I'm sorry. It's going to be due on Wednesday, April the 22nd. So we have another week before anything else is due. So if you're behind in, if you're behind in any of your assignments, go ahead and get caught up on those, if you will. But 7-1A and 7-2A are going to be due on Wednesday, April the 22nd. So that's going to be 2 weeks from now. Okay. So we got some more time, in other words, to discuss these.
Okay. Thank you.
Okay. So I'll see you next Wednesday.
All right. See ya. Bye.
Okay. Bye-bye. If there are no other questions, I'm going to stop sharing now.